This is not a video telling you to avoid consolidation. It is a video telling you how to do it correctly, so you do not end up burned by a decision that looked simple on the surface. Quick disclaimer before we go further. This video is for general educational purposes only and is not financial or legal advice. Loan terms, programs and eligibility rules change over time, so always confirm current details directly with your loan servicer or at studentaid.gov before making any decision about your own loans. Let's start by clearing something up, because this single point of confusion trips up a huge number of borrowers. Sallie Mae is a private lender. It is not part of the federal student loan system, and it never has been. If any of your loans are through Sallie Mae, they do not carry federal protections like income-driven repayment plans or public service loan forgiveness, and they were never eligible for those programs in the first place. So if you are trying to consolidate a mix of loans and wondering whether your Sallie Mae balance fits into a federal consolidation plan, it does not. Sallie Mae loans can only combine with other private loans. If you also have federal loans, those need to be handled completely separately through a direct consolidation loan with the Department of Education if you want to combine them, not through whatever refinance offer you are considering for your Sallie Mae balance. Here is the first trap. A lot of borrowers have a mix of older Sallie Mae loans and newer loans from other private lenders, and they assume that consolidating everything together automatically gets them a better deal. It does not automatically do anything. Consolidation with a private lender is really just a refinance, meaning a brand new lender pays off your existing loans and issues you one new loan with new terms attached. If your Sallie Mae loans currently carry a lower interest rate than the refinance offer you are looking at, combining them can actually increase your total cost instead of reducing it. This is exactly where a lot of people get burned. They hear the word consolidate and assume it automatically means simpler and cheaper. With private loans, it only guarantees fewer separate payments. Whether it is actually cheaper depends entirely on the new interest rate you are offered compared to what you already have, and that new rate depends heavily on your credit score and income at the time you apply, not on whatever rate you originally locked in years ago when you first took out the loan. Your credit today, not your credit history from school, is what a new lender is pricing against. Here is the second trap, and this one is specific to how Sallie Mae has operated over the years. Sallie Mae has restructured its business multiple times, and a significant number of older Sallie Mae loans were sold off or transferred to other loan services, most commonly Navient. If you are not completely sure whether your loans are still actually held by Sallie Mae, or whether they were transferred to a different servicer at some point without you fully registering it, you need to check your current servicer directly before doing anything else. Refinancing based on outdated account information can cause real payoff mistakes, like accidentally paying off the wrong account, missing a loan entirely when your new consolidation loan is issued, or leaving an old account open and accruing interest while you believe it has already been paid off. Here is the third trap, and it is one that specifically catches Sallie Mae borrowers off guard because of how the loans were often originally structured. A large number of Sallie Mae loans were taken out with a cosigner, frequently a parent, because that was often required to qualify for approval in the first place. Sallie Mae offers a cosigner release option after a certain number of consecutive on-time payments, which removes the cosigner's obligation entirely without requiring any refinance at all. Here is the trap. If you refinance your Sallie Mae loan with a brand new lender specifically to get a cosigner off the loan, instead of applying for Sallie Mae's own built-in cosigner release program, you may end up paying refinancing fees and accepting a new interest rate you never actually needed to accept, just to solve a problem. Sallie Mae already had a free built-in solution for. Before you refinance anywhere for the purpose of removing a cosigner, always check whether you already qualify for cosigner release directly through Sallie Mae first. Here is a fourth trap worth knowing about, and it is less obvious than the first three. Some refinance offers advertise a lower starting interest rate, but that rate is variable rather than fixed. A variable rate can rise over time as broader interest rates change, and what looks like a great deal in year 1 can turn into a worse deal than your original Sallie Mae loan by year 4 or 5. If you are comparing offers, Always confirm whether the advertised rate is fixed for the life of the loan or variable, because a variable rate introduces a level of risk that a straightforward interest rate comparison on paper does not capture. Let's put a real number on what these traps can actually cost, because losing money on a refinance can sound abstract until you see it in dollars. Say you have $25,000 in Sallie Mae loans at a 6% fixed interest rate, and a lender offers to consolidate it into a new loan at 7.5%, marketed heavily as one easy payment. On the surface, that sounds convenient and modern. In reality, over a 10-year repayment term, that jump from 6% to 7.5% can cost you an additional $3,000 to $4,000 in interest alone for the exact same amount borrowed. You did not save money by consolidating in that scenario. You paid extra, in real dollars, purely for the convenience of a single payment without realizing it at the time you signed. Now here is the flip side, so you can see what doing this correctly actually looks like in practice. Say you have that same $25,000 in Sallie Mae loans, but your credit score has improved significantly since you first took out the loan, maybe because you have built a solid payment history or your income has grown. A new lender genuinely offers you 4.5% instead of 6%, and that rate is fixed, not variable. Over that same 10-year term, that lower fixed rate can save you several $1,000s in interest while also combining multiple monthly payments into one. Same starting balance, same original lender, but a completely different financial outcome, purely because the new rate was genuinely lower and the terms were properly checked before signing. So what should you actually do if you have Sallie Mae loans and you are considering consolidation? Start by logging into your Sallie Mae account directly or checking with whichever servicer currently holds your loan if it was transferred, and confirm your exact current interest rate on each individual loan you hold. Do this before you look at a single refinance offer, because you need a real accurate number to compare against, not a guess based on what you remember from years ago. Next, if a cosigner is involved on any of your loans, check Sallie Mae's cosigner release requirements before you look at refinancing for that reason alone. It may solve the exact problem you are trying to fix without a new loan, new fees, or a new interest rate attached to it. After that, get quotes from multiple lenders, not just one. Refinance offers vary significantly based on your credit score, your income, and even which lender you approach, and the very first offer you see is rarely the best one actually available to you. When you compare offers, compare the new interest rate against what you are already paying today, not against some generic national average rate you saw in an ad, because your own current rate is the only number that actually matters in this decision. While you are comparing offers, confirm whether each one is a fixed rate or a variable rate, and factor that into your decision the same way you factor in the headline number. A slightly higher fixed rate can genuinely be the safer, smarter choice over a lower variable rate that carries real risk of increasing later. If the new rate is clearly lower, it is fixed rather than risky and variable, and you have no federal loans mixed in that you would be giving up protections on, refinancing your Sallie Mae loans into a single new loan can genuinely simplify your payments and reduce your total interest cost. That is a legitimate, sensible use case, and it works well specifically because there is no federal protection being lost anywhere in the process. If the new rate is not clearly lower, if it is variable and you are not comfortable with that risk, or if you are not fully sure whether all your loans are truly private with nothing federal mixed in, hold off. A slightly simpler monthly payment schedule is not worth paying more in total interest over the life of the loan, and it is definitely not worth accidentally giving up a protection you did not realize you had. One more detail worth knowing before you make a final decision. If you do decide to refinance your Sallie Mae loans, many new lenders offer a small additional rate discount for enrolling in automatic payments. That discount is worth asking about directly, since it is not always advertised clearly up front, and it can shave a bit more off your final rate on top of whatever you already negotiated. The bottom line with Sallie Mae loans specifically is this: consolidation is not automatically good, and it is not automatically bad either. It comes down entirely to whether the new rate you are offered is genuinely lower than what you already have, whether that rate is fixed instead of variable, whether a cosigner release could solve your real problem without refinancing at all, and whether you know for certain that your loans are all private with nothing federal mixed in that you would be giving up. Skip any one of those checks, and consolidation can quietly end up costing you more instead of less. If you take one thing away from this video, let it be this. Before you consolidate any Sallie Mae loan, confirm your exact current interest rate on every loan you hold. Check cosigner release eligibility if that applies to your situation. Get multiple refinance quotes rather than accepting the first one. Confirm whether each offer is fixed or variable, and only move forward once the new offer is genuinely better than what you already have in writing. For the most current information on your own loans, always check directly with your servicer or visit studentaid.gov to confirm whether any of your loans carry federal protections you would not want to lose. If this helped you avoid getting burned on a Sallie Mae consolidation, you know what to do. And if you are still figuring out the basics of how student loan consolidation actually works from the ground up, step by step, that video is coming up next.